There is a number that almost nobody in the silver market is talking about, not the spot price, not the all-time high, not the next resistance level on a chart, a different number, a threshold, a trigger point. And when silver crosses it and stays above it, something happens that changes the entire supply equation in ways that most analysts, most commentators, and most investors are completely ignoring. That number is approximately $70 per ounce. And what happens above it is this: the largest untapped stockpile of silver on the planet, a stockpile measured not in millions of ounces but in tens of millions, begins to move. Not from mines, not from central bank vaults, not from COMEX warehouses, from your old phone, from the circuit boards in a landfill, from the decommissioned solar panels sitting in a warehouse, from the 62 million tons of electronic waste the world generated in 2022 alone. Most of which was never recycled. Most of which is sitting there right now, with silver locked inside it, waiting for exactly this price environment to make extraction economically viable at scale. This is the story almost nobody is telling. And it matters enormously whether you are bullish or bearish on silver. Because if you are bullish and ignoring the recycling trigger, you may be overestimating scarcity. And if you are bearish and assuming this supply will arrive overnight, you may be underestimating the cost barriers that stand between scrap and refined metal. The truth is somewhere in the middle. And today I'm going to show you exactly where, with real math, real cost data, and a framework that lets you evaluate this for yourself. Hello everyone, Ken AG here. Before we get into the numbers, the necessary disclaimer. This content is educational and informational. It is not financial advice. I am not recommending that you buy or sell anything. Do your own research, make your own decisions. What I can do is show you the data that most people never see. Let me start with the question that drives the entire analysis. How much silver is actually locked inside electronic waste? The honest answer is that it depends on the scrap, and the variation is enormous. But let me give you the framework so you can think about this properly. The most valuable target in e-waste is the printed circuit board, the PCB. These boards represent a small fraction of total e-waste by weight, somewhere in the range of 3 to 6%. But here's what makes them so important. They concentrate a disproportionate amount of the metal value. Economic assessment studies have shown that PCBs can account for more than 40% of the total metallic value in electronic waste, despite being a small fraction of the mass. That is why professional recyclers pull the boards first. That is why when you see images of e-waste recycling facilities, you see people sorting boards into categories. The boards are where the money is. Everything else often sits dormant, waiting for economics that justify processing it. Now, silver content within those boards is not fixed. It varies widely depending on the type of board, the age of the device, and the application. Published characterization studies show PCB silver content ranging from as low as 0.01% by mass to as high as 0.52%. Let me translate that into practical numbers. At the low end, 0.01% means you are getting roughly 1/10 of a kilogram of silver per ton of boards. That is almost nothing. At the high end, 0.52% means 5.2 kilograms per ton. That is commercially meaningful. And the average sits somewhere in between, depending on the mix of boards you are processing. But here is the detail that changes how you think about this. Silver in electronics does not sit randomly inside the device. It sits in specific locations where electrical performance matters most. Contact plating on connectors, conductive inks and films on circuit boards, membrane switches, RFID components, silver oxide batteries. These are what I call high-density islands inside products that appear ordinary. Your average consumer looks at a discarded laptop and sees trash. A metallurgist looks at it and sees a concentration of precious metals in very specific, recoverable locations. Understanding that distinction is the difference between thinking e-waste recycling is a fantasy and understanding why it is already a real industry. Now let me flip your thinking on the economics, because this is where most people get confused. And I mean genuinely confused in a way that leads them to completely wrong conclusions. There is a phenomenon you see all over YouTube and social media. Someone takes a handful of old circuit boards, dissolves them in acid in their garage, and precipitates out a tiny amount of silver or gold. They calculate the value at spot price, subtract the cost of their chemicals, and declare that e-waste recycling is incredibly profitable. And the comments fill up with people saying they are going to start doing this tomorrow. That calculation is wrong, dangerously wrong, and it is wrong for reasons that are invisible to someone working in their garage but are absolutely brutal at industrial scale. First, the regulatory reality. E-waste contains hazardous metals and contaminants: lead, cadmium, mercury, brominated flame retardants. When processing is informal, when someone is doing open burning or uncontrolled chemical leaching in a backyard, the cost of dealing with those contaminants does not disappear. It just becomes invisible. It gets externalized onto the environment, onto the health of the person doing it, onto the community around them. Published characterization studies have found heavy metals in e-waste leachate at levels well above safety reference limits. This is why e-waste processing is regulated. This is why you cannot just set up a drum of nitric acid in your driveway and call yourself an urban miner. And the regulatory environment just got significantly tighter. As of January 2025, International Convention amendments made transboundary movements of e-waste, including categories previously considered non-hazardous, subject to prior informed consent mechanisms. That means prior approval from importing and transit countries before material can cross a border. Paperwork, traceability, classification, insurance, licensed operators, hazardous waste storage protocols, auditing, all of that goes into the cost base before a single ounce of silver is recovered. So the amateur thinks he is doing urban mining. Industry is doing chemistry plus metallurgy plus environmental compliance plus risk management plus logistics plus capital deployment. Those are completely different operations with completely different cost structures. The amateur's profit margin exists only because he is not counting what he is not paying for. He is not paying for proper hazardous waste disposal. He is not paying for the health consequences of inhaling fumes from dissolving lead-laden solder. He is not paying for environmental remediation. He is not paying for the licensing and insurance that a legitimate operation requires. He is not paying for the capital cost of equipment that can handle volume, and he is certainly not accounting for his own time at any realistic hourly rate. When you add all of those invisible costs back in, the garage operation is not profitable. It is subsidized by externalities, and that is exactly why it cannot scale. You cannot build an industry on ignoring costs. The costs catch up. They always catch up, either through regulation, through litigation, through health consequences, or through the simple reality that investors will not fund operations that depend on breaking rules to make money. Now let me show you what the real cost structure looks like, and this is where it gets fascinating. European studies modeling PCB recycling profitability across the full chain, from dismantling through pre-treatment through refining, show a clear cost hierarchy. The largest single line item is typically scrap acquisition, what you pay to obtain the boards, then labor, then energy and chemical reagents, then transport, taxes, capital expenditure, and regulatory compliance. One detailed economic model puts the baseline unit cost of acquiring waste PCBs at approximately 1,200 euros per ton. Convert that at recent exchange rates and you are looking at roughly 1,400 US dollars per ton just to get the boards in the door, before you process them, before you pay your workers, before you turn on a single piece of equipment. So what is the number? What is the exact price trigger where the economics flip, where the system shifts from dormant to active, where the millions of tons of silver-bearing waste sitting in warehouses and landfills and recycling yards start moving toward refineries instead of sitting still? I am going to give you two numbers, because the honest answer depends on which question you are actually asking, and showing you both numbers is more powerful than showing you one, because the gap between them reveals exactly why this market is so misunderstood. The first number answers the scrap market question. At what silver price does the silver content of a moderately rich board pay for the cost of acquiring that board? This is the number that matters for industrial scale recyclers who are recovering the full suite of metals, silver plus gold plus copper plus palladium. Here is the calculation. A well-documented UK precious metals recovery plant designed to process up to 4,000 tons of boards per year has a potential silver output of approximately 2.5 tons per year. That works out to about 0.625 kilograms of silver per ton of boards, which is approximately 20 troy ounces per ton. Now take the board acquisition cost from the European economic model, roughly 1,200 euros per ton. Convert to US dollars at recent rates, approximately $1,400 per ton. Divide acquisition cost by silver yield per ton, $1,400 divided by 20 ounces. You get approximately $70 per ounce. That is the first magic number. At around $70 per ounce, the silver content alone begins to cover the cost of acquiring the boards. Everything above that, and everything recovered in gold, copper, and palladium, becomes margin and scalability. Below 70, the silver contribution is insufficient to carry the scrap cost, and operators need the other metals to justify the operation. Above 70, silver starts pulling its own weight, and the economics of accepting lower-grade lots improves significantly. Now here is why this number matters so much in February 2026. Silver is trading around $77 per ounce. We are above the trigger. We have been above the trigger. And that means the economic incentive to process silver-bearing e-waste has shifted from marginal to meaningful. Not overnight, not with the flip of a switch, but structurally, persistently, in a way that changes behavior at the industrial level. The second number answers a different question. A more literal question that I know some viewers are asking. At what silver price would extracting only silver from circuit boards be profitable, ignoring all other recovered metals? The answer to that question is humbling. Hydrometallurgical economic analyses that model the full capital and operating cost structure with realistic silver recovery yields of roughly 1.5 kilograms per ton of boards produce a silver-only break-even in the range of $265 to $308 per ounce. That is not a typo. If you were only recovering silver from PCBs and throwing away everything else, you would need silver at approximately $300 per ounce to break even. This is the number that should permanently end the myth that amateur garage refining is profitable. The reason those YouTube videos look like they make money is because they are also recovering gold, which dominates the revenue in typical PCB processing, even at very low concentrations, or they are ignoring costs, or both. Silver is valuable in e-waste, but it is rarely the star of the show. It is the supporting actor that makes the economics work when combined with gold, copper, and palladium in the same recovery stream. Now let me compare this with the cost of producing silver from traditional mining, because this comparison is essential for understanding the full supply picture. And it is the comparison that most recycling enthusiasts never make, which is why they consistently overestimate how quickly recycled supply can scale. Company-level data and sector analyses show all-in sustaining costs for primary silver production in ranges like $13 to $26 per ounce, depending on the producer, the jurisdiction, and the byproduct credits they receive from copper, lead, and zinc produced alongside silver. Those numbers are vastly below the recycling break-even. A mine producing silver at $15 or $20 per ounce is operating in a completely different economic universe than a recycler whose system cost starts at $70 per ounce just to cover scrap acquisition. And that tells you something critical. The recycling trigger is not about competing with mine costs on a dollar per ounce basis. Recycling will never be as cheap as pulling silver out of the ground as a byproduct of copper or lead mining. The recycling trigger is about a different question entirely. It is about when the spot price allows recyclers to pay for scrap, fund the logistics, fund the regulatory compliance, and still generate a margin on the full recovered metals package. That is a systems question, not a unit cost question. And the answer to that systems question is approximately $70 per ounce for the scrap acquisition trigger. Now let me connect the microeconomics to the macro picture, because this is where the implications for the silver market become significant. The silver market already has a meaningful and growing supply contribution from recycling. Global silver recycling rose 6% in 2024, reaching approximately 194 million ounces. That was a 12-year high, driven significantly by increased recovery from industrial scrap. That number by itself represents a functioning relief valve. When prices rise, when incentives improve, the system responds by returning more material to the market. But here is the part that should make anyone building a silver thesis sight up and pay attention. The reservoir from which this recycling supply can grow is enormous. In 2022, global e-waste generation was approximately 62 million tons. Published WEEE composition data estimates an average silver content of roughly 21 grams per ton across the total waste stream. Not selected high-grade boards, the entire stream average, including low-value components. Multiply those two numbers together. 62 million tons times 21 grams per ton. You get approximately 1,300 tons of silver embedded in a single year of global e-waste generation. Convert that to troy ounces, and you're looking at roughly 43 million ounces locked in electronic waste, generated in just 1 year. And that waste is cumulative. It's been accumulating for decades. The stockpile grows every year, because collection rates are low and declining. Projections show e-waste generation reaching 82 million tons per year by 2030, while documented collection rates may fall to around 20%. This is a colossal reservoir, and it's sitting there, waiting for exactly the price environment we are entering. There is a second reservoir that most people are not even considering: decommissioned solar panels. Global monitoring data projects retired photovoltaic panels reaching 2.4 million tons by 2030, roughly 4 times the 2022 level. Even with thrifting, even with lower silver loading per panel in newer generations, the mass flow of retired panels is growing fast enough to create a meaningful secondary silver source. And the same economic trigger applies. When spot price makes processing worthwhile across the full metals package, material that was sitting in warehouses begins moving to refineries. Here is the inference, and I want to state it explicitly. When silver crosses and sustains above a trigger like $70 per ounce for certain scrap streams, companies that previously only processed premium, high-grade lots begin accepting lower-grade material, because at those prices, silver starts paying a bigger share of acquisition and logistics costs, and gold, copper, and palladium close the margin. That behavioral shift, that expansion of what is economically worth processing, tends to increase secondary supply elasticity above the trigger. More material enters the pipeline. Recovery rates improve. Supply increases not linearly but in step functions as different grade tiers become economic. Does this mean silver is about to collapse under a flood of recycled supply? No. And this is the nuanced part that separates serious analysis from clickbait in either direction. The barriers to scaling recycling supply are real and they are substantial. Regulatory costs are increasing, not decreasing, as international frameworks tighten around transboundary waste movement. New processing technologies and greener chemistry routes exist in laboratories, but they face significant industrialization bottlenecks. Leaching chemistry has rate and time limitations that constrain throughput at the plant level. Capital deployment into recycling infrastructure takes years, not months, from feasibility study through permitting, through construction, through commissioning. Worker training and specialized expertise are in short supply, and even at full theoretical potential, even if every barrier were overcome tomorrow, recycled silver from e-waste would be supplemental supply. It would add to the market at the margin. It would not replace primary mining as the backbone of global silver production. But ignoring it is equally wrong, because the supply floor in silver is not determined solely by mine costs. It is about the full system, mines plus recycling plus inventory drawdowns plus scrap economics. And the scrap economics just shifted. They shifted because silver at $77 per ounce sits above the trigger that changes industrial behavior, not by a little, by enough to matter. For anyone building a silver thesis, whether bullish or bearish, this is the framework that deserves attention. The trigger is real. The stockpile is enormous. The barriers to mobilizing that stockpile are significant but not permanent. And the price environment we are in right now is the price environment where recycling supply begins to accelerate, not explode. Accelerate, gradually, structurally, in a way that adds supply at the margin and acts as a relief valve on the most extreme scarcity scenarios. The market is not pricing this in. Most commodity analysts are focused on mine supply and industrial demand. They are not modeling the behavioral economics of scrap processing at different price tiers. They are not quantifying the step function in recycled supply that occurs when specific thresholds are crossed. And that blind spot, that gap between what the market models and what the physical system actually does, is exactly the kind of information asymmetry that creates opportunities for people who do the math. So, do the math. Track the recycling data. Watch the scrap spreads. Understand the cost structure. Know the trigger points. Know that $70 is the number where silver starts paying for the board, and that $300 is the number where silver alone justifies the operation without byproducts. Know that reality lives between those two numbers, and that the current price environment sits right in the zone where industrial behavior is changing. And remember that in commodity markets, supply does not come only from the ground. It also comes from the past. From the billions of devices the world manufactured, used, discarded, and forgot about, from the 62 million tons of e-waste that accumulates every year, from the decommissioned solar panels that will multiply fourfold by the end of this decade. The past is a stockpile, and when the price is right, the past has a way of showing up at the refinery door uninvited and in volume. If this video helped you see a part of the silver market that most people overlook, hit the like button and subscribe. I want to hear from you in the comments. Do you think recycled supply will be significant enough to cap silver's rally? Or are the barriers too high for it to matter at scale? Leave your take below. I read the comments and I respond when I can. Thank you for watching until the end, and I will see you in the next one.